Well, good morning, one and all, and welcome to day 2 of Ausbanking 2025. My name's Adam Spencer. I'm your MC again today. Before I run through a couple of items of housekeeping and get the day going, that's our much talked about QR code for feedback on day 1. So if you haven't done it yet, please scan that now and give us thoughts on the speakers and sessions from yesterday. Crucial for the event organisers and getting together future conferences and events. And while you're doing that, I'll run through a couple of small items of housekeeping and then kick us off. But if you haven't done it yet, please scan the QR code. You look around and see some people with a bit of a smug look on their face. They got here early. And I announced about 10 minutes ago that was the QR code. They've already given us feedback. But if you'd like to hop on and let us know what you thought about yesterday's sessions, it is actually a crucial pillar on which next year's event will be built. Welcome you all to day 2 of this event on Gadigal land here at the ICC in Sydney. Just throw your hand in the air if you're joining us today and you weren't here yesterday. Anyone who wasn't here yesterday? That gentleman down the front there. In the unlikely event of an emergency, just do what everyone else does because they were here yesterday and we ran through it. We're all good to go. Hashtag Ausbanking 2025 if you want to share anything on your socials during the course of the day. We've got some great sessions lined up touching on some of those key topics that we looked at yesterday in navigating disruption, our overarching theme for 2025. Before we go to our first speaker of the morning, we're going to roll a little video on the banking code. Not just any banking code, no. The all-new, fully refreshed, fit for purpose, as the kids say on TikTok when they buy something and then this is like an unboxing of the banking code. Turn your attention to the big screens.
The Banking Code of Practice sets the standards of service, practice and integrity in Australia's banking industry. The latest 2025 update introduces important new protections for customers. Here's how it's changing. Small businesses are the backbone of our economy, and this code offers greater protections to 10,000 more small businesses across our economy. The new code has broadened the definition of small business, which means that more businesses now have access to these very important safeguards. Things like clearer loan processes and access to help if things get tough.
It is really important and helpful that we're now protected under the code. It means that our contracts are more simplified, the processes are more transparent. The code ensures that the relationship between us as a customer of the bank is more collaborative. It's a fairer ground for us to be standing on, and the expectations are set out a little bit clearer up front.
This version of the code introduces new obligations for banks to meet with guarantors to make sure they understand the risks involved before signing up. Banks will have open conversations explaining everything clearly so that everyone is on the same page. Banks know that sometimes things don't go to plan. Financial difficulty can be stressful and overwhelming.
Anyone can experience hardship across your lifetime. You might lose your job, you might have a family emergency, you might have a natural disaster that affects you. Reach out to your bank, reach out to a financial counsellor, reach out to your support networks, talk about what's going on in your life.
We want you to know that we're here to support you through your financial difficulty, and we're committed to helping you get back on track. Your bank will have several programs and options specifically designed for situations like yours, and many of our customers have found relief through these programs.
It's really important across Australia. There are some consistent standards and expectations that people can have about how they might be treated, but also all of the possible variations of what support they could receive.
This code provides greater clarity on the support that banks offer, including restructuring loan payments, help to access financial counselling, and working to find customers the right solution for them.
Banking is an essential service. Everyone has a relationship with money, and having access to independent interpreters will give people an opportunity to engage with equality, dignity, and respect in a system that is so meaningful for their everyday lives, where they can understand what their rights are, where they can have the ability to make an informed decision, because the message for them will be in language. This is going to change lives for millions of people who access banking services.
This updated Banking Code of Practice is a significant step forward for Australia's banking industry. It's about doing what's right for our customers and ensuring important protections are there for small business owners and people. Together, We're building trust and setting new standards for the future.
Great stuff. There you go. The ABA website has some really good resources on this. The full code translatable into multiple languages and the like. If there's anything else you need to go to the ABA website for all the details on the updated banking code. Okay, so to kick us off now for day 2, as I mentioned yesterday, we simply could not provide what we're providing over yesterday and today without the support of our wonderful partners. Our gold partner, King & Wood Mallisons, are going to present our first keynote speaker of the day, here from KWM, partner Max Allen, to say a few words. Please give Max a big round of applause. Yours, mate.
Good morning, everyone. I'd like to thank the ABA for allowing me to introduce, on behalf of King & Wood Mallisons, our keynote speaker for this session. Before I do, I would like to congratulate Anna and the entire ABA team for this excellent conference. We are very grateful here at KWM for the opportunity to continue to support you, ABA members, and this important gathering of the leaders of our industry. And Anna, personally, exceptionally well done during your tenure as CEO of the ABA. Thank you for your leadership during some really challenging times for Australia and our banking sector. All the best for the future. And Simon, a very warm welcome. We in the industry are really looking forward to working with you. At last year's conference, we focused on resilience in the face of unpredictability. And this year, we're exploring how disruption is reshaping our financial system. This theme is topical not only for Australia, but for the global banking system. Earlier this month, the chair of the BAL Committee on Banking Supervision observed, "We are living through a period of profound change, from the accelerating pace of technological innovation to shifts in the structure and shape of the financial system to increasing geopolitical fragmentation. The environment in which banks operate is evolving rapidly and often unpredictable." Many of yesterday's sessions explored these themes and the resulting challenges and opportunities they present for the industry going forward. Now on today's program. Introducing our keynote speaker, John Lonsdale, is a special privilege for me. I had the great privilege of working as part of John's markets group when he was Deputy Secretary at the Commonwealth Treasury, working with the government as it introduced reforms to ensure the resilience of our key financial institutions and our financial market infrastructure. John was a classic leader of Treasury, deeply respected and admired by his peers and the market. In his role as Deputy Chair and now Chair of APRA, John has done extensive work to support a strong, stable and resilient banking system in the face of uncertainty and complexity. And he is continuing to do so with important standards on operational risk management, cybersecurity, governance and resolution planning. Importantly, as we navigate towards a digital future, John brings a broader perspective to the task. He has a long history in establishing, protecting and improving our financial system, including through leading the Secretariat to the Financial System Inquiry in 2014 and his roles on the Payment System Board, the Council of Financial Regulators and other important bodies. With that, thank you, John. Over to you. Thanks very much.
Good morning, everybody, and thank you. Thanks for the kind introduction, Max. It's really great to be here with you. I want to start with uncertainty. In 2016, a group of American economists published their first economic policy uncertainty index in Australia. And what it focused on was really a trawl through newspapers and media outlets for a search of the word uncertainty or economy, put together an index, and they measured economic uncertainty in Australia in October 2001, month of the 9/11 terrorist attacks, just after, at 271. It reached 291 in October 2008, so the GFC, and until recently, the high was 329, which was recorded in July 2016. So you remember that was Brexit, the Nice terrorist attacks. And then in March this year, the index reached 382 before rocketing to 625 when the Liberation Day tariffs were announced. Australians are far from alone in feeling uncertain. The VIX index is currently recording some of the highest levels of volatility since the start of the pandemic. And meanwhile, the World Uncertainty Index, developed by economists at the IMF and Stanford, is registering the highest global levels of uneasiness for 60 years. As a mid-sized economy dependent on overseas markets for capital investment, Australia's financial system is deeply interconnected with the international economy. Whether it's the prospect of a trade war sparking a global recession or a major cyber attack on the payment system, Australians expect their banks, their insurers and their superannuation funds to be resilient and prepared for these risks. And APRA's prudential framework and the way that we supervise against that seek to ensure that they are. A well-regulated financial system may be a prerequisite for long-term economic growth, but regulation is not cost-free. Compliance costs money, consumes time and resources, and it also puts limits on things. We'd say that's for good reason, on the risks businesses can take. Earlier this month, APRA and many other regulators received a letter from the Treasurer asking us to identify specific measurable actions to reduce these compliance costs. Importantly, this is very important, he's asked us to do this without compromising standards. While we're still drafting our response, this morning I'd like to outline how we're thinking about striking this balance, with a particular focus on banking. As part of the CFR's review on small and medium-sized banks, APRA has identified a range of areas where we believe we can adjust some of the regulatory requirements and provide more scope for sensible risk-taking. But given the level of volatility and uncertainty in the operating environment, there are also other areas where we believe vigilance is critical. And I'd call out three, which I'll talk about later. One's cyber, one's operational risk, and the other is geopolitical risk. Having begun this speech with a focus on uncertainty, let me pivot to something APRA is certain about, and that's the resilience of the Australian banking system. And that view was reinforced by the results of our most recent annual bank stress test. For the 2024 stress test, the hypothetical scenario we presented featured a deep and prolonged global economic downturn triggered by a significant shock in the Asia-Pacific region. The downturn was transmitted to Australia through sharp falls in trade and commodity prices, leading to a GDP fall of 4%, unemployment rising to 10%, and house prices falling by 40% over a 3-year period. On top of all of this, we asked each bank to identify a service provider, a material service provider that fails to a cyber attack, causing a critical system problem. The results of the stress test found that banks, even before mitigating actions, had sufficient capital to withstand the impacts, continue to lend to support an economic recovery, and that's very important. Banks' liquidity was a key focus for this stress test. The systemic stress triggered a rapid closure of banks' access to global funding markets, intense competition for deposits, a 3-notch credit downgrade, and redemptions of banks' existing negotiable certificates of deposit, a key funding source. The results of the stress test indicate that banks, again, before mitigating actions, were able to continue to meet their liquidity obligations as they fell due during a severe downturn. These results should give the community confidence that our banking system, armed with unquestionably strong levels of capital, has the capacity to withstand a significant sudden deterioration in economic conditions. And if all banks were required to do was keep deposits safe, that might be enough. But banks obviously play a broader and more important role in society. They lend money to households and businesses. They facilitate access to funds through digital channels. branches, ATMs, that allow goods and services to be bought and sold. Many in the community question whether an industry dominated by only 4 major banks provides sufficient competition to optimise standards of service, keep branches open and put downward pressure on interest rates and fees. These concerns lie behind the CFR and the ACCC's review examining the level of competition provided by small and medium-sized banks. As part of that review, we looked at how regulation and other barriers impact the ability of small and medium-sized banks to compete. Earlier this month, we handed our report to the Treasurer, and while the Treasurer will release the findings of the report in due course, I can confirm that APRA identified a number of areas where we believe we can make our framework simpler and more proportional without introducing unacceptable risks, and I'd like to outline those to you today. Our first commitment is to formalise a 3-tier approach to proportionality in the framework for banking. At the moment, you'll know that we've got 2. Significant financial institutions and non-significant financial institutions. APRA will soon move towards having 3 tiers in banking, roughly corresponding to large banks, or the majors, medium-sized banks and small banks, or the non-SFIs. This change will allow us to introduce more nuance into our policy and into our supervision approach to banks, and we'll be able to greater differentiate between requirements for different bank business models. Commitment 2 is to streamline and simplify our accreditation process that allows banks to use the IRB approach to calculating risk-weighted assets. Getting approval to use this approach, if you've ever done it, requires significant investments of time and money by banks, but the benefit can be a slight reduction in capital requirements. While APRA has long argued that this benefit is not as large as some critics maintain, we want to make sure our processes are simpler and more transparent for banks to navigate. Our third commitment is to better communicate to banks our decisions on minimum capital requirements under Pillar 2 of the Basel framework. Feedback to the CFR review indicated that a lack of understanding by banks around the reasons for Pillar 2 adjustments can make it difficult for them to address APRA's concerns. As a result, we have committed to more clearly explaining the basis for those decisions and, importantly, what risks need to be addressed for certain capital adjustments to be removed or lowered. The final action APRA committed to is to amend our bank licensing framework with the aim of making our expectations more transparent and the process more efficient. While we can't control the flow of new applicants, we can make our processes as efficient as possible to give high quality entrants the best possible chance of success. Together, we believe these measures strike a sensible balance between lowering the regulatory burden for banks while ensuring banks of all sizes have the financial and operational resilience to protect their depositors. Finding this sweet spot between adequately protecting the community and not unduly burdening industry requires us to make constant trade-offs between risk and reward. As the prudential regulator, our primary consideration must be financial safety and stability. Our commitment to getting the balance right, therefore, can't be about reducing the resilience of the system or holding back where we think risks are building. But we do need to be mindful about the impact of our work on competition and efficiency and resist the urge to introduce requirements that are nice to have but not really essential for stability. This mindset has contributed to a range of actions that we've taken over recent years to simplify and streamline requirements and increase proportionality in our system. These include our program to modernise the prudential framework, ongoing work to remove or pare back duplicative or lower value data reporting requirements. Our upcoming corporate plan will outline further initiatives aimed at reducing regulatory burden in areas, and this is important, where it is safe to do so. Perhaps the most scrutinised area where we try to strike the right balance is with our macro policy tools, especially in relation to home loans. As a society, we want aspiring homeowners to be able to access the credit they need on fair terms. And while recent data shows first home buyers remain well represented in new lending, the relentless rise of property prices over recent decades has made it difficult for many borrowers, especially young adults, to buy a house. But we also recognise that it's not in anybody's interest for borrowers to be unable to meet their repayments. That's bad for them, it's bad for the lender, and potentially bad for everybody. The Australian banking system has more exposure to residential mortgages on variable interest rates than any other comparable economy in the world. Residential mortgages make up 2/3 of all bank loans in Australia, compared to 30% in Europe and 10% in the US. Australians also have one of the highest levels of household debt relative to income in the world. As a result, we are uniquely exposed to a shock impacting households' ability to repay their home loans. Using the macro prudential policy tools available to us, we try to strike a balance to ensure this risk is being adequately managed through sound lending standards, but the credit continues flowing to support the economy. Yesterday, we announced that we are keeping our macro-prudential settings on hold after considering factors such as household debt levels, credit growth, labour market conditions, as well as the instability in the geopolitical environment. Lower interest rates have helped to ease cost of living pressures on borrowers and increase borrowing capacity for new borrowers. And we have seen credit continue to flow to different borrower segments, including to first home buyers. Lending standards are currently sound, but looking ahead, one concern that we have is that in the event of lower interest rates, we could begin to see a rise in riskier forms of residential lending, which is historically what often occurs when the financial risk cycle picks up. It's important to be forward-looking and prepared for potential risks in the financial cycle in the future. With that in mind, we will soon begin discussions with entities around implementation aspects of our various macro-prudential tools to manage lending risks, including limits on some forms of lending. We want to ensure such tools can be activated in a timely manner if they are needed. Another area where we have weighed up competing objectives relates to the 8 proposals we announced in March as part of our governance review. We've tried to strike a balance between prescription and flexibility, between larger and smaller entities, and between setting minimum requirements and allowing boards the flexibility to make their own decisions. Since releasing that discussion paper, we've spent a great deal of time listening to industry views on whether we've got that balance right. During the 3-month consultation period, APRA received nearly 80 submissions. That's a lot for us. We've had 50 meetings and roundtables, and we've spoken to 150 organisations. So we've done a lot of listening and we've done a lot of reading. We've been pleased with the broad and constructive engagement on the review to date. We've heard in some broad support for the package overall, which is generally consistent with global best practice. While there's been enthusiasm for proposals such as enhancing clarity around board roles, we've also heard caution around the potential impacts of other proposals, including independence within corporate groups and the proposed 10-year limit on board tenure. My message to you today is to confirm that this is a genuine consultation. While we're not prepared to keep the status quo, we recognise that there is enormous variation in size, complexity and business models, and we are mindful of not being unduly prescriptive. We want outcomes, but we don't want to prevent entities from achieving these outcomes in different ways. With that in mind, we continue to reflect on the feedback we've received, and we are looking forward to providing an interim update in the next few months on how we're seeing it. Sticking to the theme of listening to feedback, last month we published our biennial stakeholder survey. Among the questions we asked was this one: which business risks most concern banks, insurers and superannuation trustees? The number one concern was cyber risk. The number two was geopolitical risk, and the third was operational risk. In fact, it could be said that there's a perfect storm of factors converging to amplify all three risks. There's growing operational dependence of the financial system on digital technologies. We're seeing increased interconnectivity and reliance on third parties to provide critical operations. And there are clearly shifts in geopolitical environment that increases risk to the financial system. Which brings me to my final point. There are areas where APRA can increase proportionality or ease requirements in a way that does not impose unacceptable risks to safety, but there are also areas where risks are growing and regulated entities need to do more. In all three of these areas, cyber, operational risk and geopolitical risk, APRA continues to observe vulnerabilities that boards and management teams must simply get ahead of. On cyber risk, one of the most pressing issues is weaknesses in authentication controls, an issue that was highlighted by the credential stuffing attacks on several superannuation funds that emerged in April. This issue prompted a heightened focus by APRA on how trustees are managing cybersecurity. However, banks can't afford to be complacent or assume that they don't have similar vulnerabilities. Our Prudential Standard on Information Security, CPS 234, we give numbers to all these things, requires entities to have controls commensurate with the threat environment. And this is something all entities must continue to review as the cyber threat environment worsens. On operational risk, more broadly, the increased reliance on third-party service providers continues to be a growing vulnerability that entities must manage. Events such as the CrowdStrike outage last year and the more recent targeting of Qantas customer data show how third-party weakness can lead to significant operational risks. APRA's new Prudential Standard on Operational Risk Management, CPS 230, came into effect on 1 July, emphasises the need for entities to have an end-to-end understanding of their reliance on material service providers, set appropriate tolerances, and be proactive in scenario planning for potential operational risk events. Amplifying both cyber and operational risk is the current elevated geopolitical turmoil. APRA and our CFR colleagues have been working on a geopolitical work program for some time now to strengthen the resilience of the financial system. Heightened international tensions could lead to risk transmission through traditional financial and operational risk channels, as well as through non-traditional channels such as personnel risks. Back in 2019, APRA warned that a significant cyber incident impacting banks, insurers or super funds was a matter of when and not if. With recent hacking of multiple major super funds, that has indeed come to pass. To date, the impact on customers has been relatively limited at an entity and system-wide level, but amid the perfect storm of factors I referred to earlier, entities must continue to be vigilant. With so much at stake, our tolerance for gaps or weaknesses in how these risks are being managed has never been lower. With CPS 230 now in effect, we'll be carrying out a series of prudential reviews into how entities are complying with the new standard. We'll be starting with the larger entities first. On cyber, we see a need for continued focus on baseline resilience across all industries, and we'll be conducting further reviews to understand how entities are meeting the requirements of CPS 234. So, it's sometimes said that the greatest risk in life is not taking any risk. And for the economy to grow and living standards to rise, we need people to take financial risks, to buy a house, to open a new factory, to hire more workers. And the Australian banking system is integrally important to the ability of households and businesses to finance those risks. And in any competitive industry, not all risks will pay off. But a restaurant or a tech startup that fails does not have the potential consequences as the failure of a bank. Given the threat to depositors' savings and community confidence in the financial system, the privileged position in our economy that banks hold therefore comes with heightened responsibilities, and we codify that in regulation. Not to stop banks taking risks, but to ensure those risks are properly understood and well managed. APRA likewise has a privileged position that brings significant responsibility. It's a responsibility we wear with gravity it deserves as we try to balance the need for a safe and stable financial system with the need for a competitive banking sector and a dynamic and innovative economy. The measures I've outlined today try to strike the right balance between protecting the community while easing the regulatory burden on banks, including small and medium-sized banks that bring important competitive pressure. APRA will continue to look for ways to enhance proportionality and cut red tape where it's safe to do so across industries we supervise. But in a deeply uncertain world, we will also lean into the areas of escalating risk so Australians can be confident that our financial system remains protected today and prepared for the challenges of tomorrow. Thank you very much, everybody.
Thanks, John. Do you want to take a seat?
Thanks, Sam.
John's got time to answer a couple of questions. You know how this works. Don't be shy. Throw your hands in the air and grab the attention of the microphone wranglers if there's a question you'd like to ask John. Thanks for the presentation. Can I start? A wise man once said, the greatest risk in life is sometimes not taking any risk at all. And that was you about 2 minutes ago. Interest rates, the recent Reserve decision to hold steady, every economist in the country was saying they're going to go down. The board was split 6-3, so at least three very reputable thinkers were going, yeah, let's cut. Is there any risk your position on that's a little bit too conservative?
Well, this is something that we watch very closely, and I don't want to comment on what the RBA is doing, but we do think that we're at a turning point in the financial cycle. We've seen interest rates come off, and when you look through history, what you tend to see at this point in the cycle is pick up in credit growth, pick up in leverage, pick up in asset prices, particularly housing, and it's something that we worry quite a bit about. Also, traditionally what you'd see is pick up in some higher risk forms of lending, and that's something that we want to really face into and manage those risks. We announced yesterday, as I said in the speech, our macroprudential policy settings update. We're keeping those settings the same, but we flagged importantly that we want to be ready. We want to be ready in case we need to act, and so we are talking to entities about making sure they are ready, but it's certainly a watch point for us.
News breaking overnight, a superannuation fund's had to warn its members their personal information may have been compromised, not from a ransomware attack, not from malicious hackers, but a series of break-ins at Australia Post in Melbourne, which might have got to a mailbox where their mail was being... I did not have that on my radar as one of the threats to superannuation members. Do we even... I think, is that a Rumsfeld unknown? Do we even Are you confident we know all the risks?
Well, we've got to do better at understanding the risks. So the risks that we're regulating directly are those in the institutions we regulate, but we've been front and centre in saying, actually, there are third party and there are fourth party risks, and entities need to be on top of that. And so that is something we need to face into. We need to make sure the right governance, the right controls are in there to be managed, but it's something that we've got to keep on vigilant about, not just entities, but the community itself. 3
hands in the air, please. Grab the attention of the microphones if you'd like to ask John a question. We've got a question down the front here. Microphone coming to you, Anna, and then right next to you, another question. Fantastic. Fire away, Anna. What would you like to ask John?
Thank you very much, John, for being here today and for your presentation. Very, very welcome news on the 4 commitments that APRA is making in relation to the review of competition, particularly for small and mid-tier banks in the sector. So thank you to you and your team for having an open mind on some of those issues, particularly the first 2 around the 3 tiers and the second one around the IRB process, the accreditation process. Do you have any thinking at this stage on how, on the time frame it might take to implement those, and when people might see, what that 3-tier looks like and what the accreditation process might now be, how that might be framed?
So thanks, Anna. I mean, so they're all different, but you will start to see some very shortly. For example, licensing, we committed to that. We'll very shortly be issuing a paper on that. So we will progressively move forward on that, so that you can expect to see it very soon. And we're moving ahead. We're not waiting, and that's why APRA have made certain commitments, and we're just moving ahead. We see this as business as usual. We've got to balance safety with competition and efficiency, and that's what we're doing.
Right. Question there. What would you like to ask, mate?
John, thanks very much for your presentation this morning, and thanks for your time. Again, I'd just like to reiterate Anna's comments and saying thanks very much for listening to us. We've been talking to you for a long time about some of these things, and it's great to see you announce this morning some of those changes. It's not the first time that you've listened to us and taken things into account, and I really appreciate that. I know you've got a very difficult job. One of the things I just wanted to ask you was the latter part of your discussion, you spoke about the governance issues. And there's been a lot of discussion about director tenure and your view on some hard limits on director tenure. I just wanted to wonder if you could give us some more colour on that as you're going through your contemplations and taking that feedback and reading all of the interesting submissions that you've got, and also I'm sure some of the consultation and verbal submissions you've had as well.
Well, that's one of the issues people have raised with us, one of the more contentious ones. I mean, we put out a consultation paper. We said, basically it's important to have good governance to make sure we've got good results. And part of that's making sure that we've got independence on boards, we've got freshness, we've got fresh thinking. And, frankly, we've got directors on regulated boards that have been there 20 years, 25 years, in some cases 30 years, like it's a career. And what we're saying is we think that there is good grounds to have less time on one board, and we set those out in the discussion paper. I don't think anyone has really pushed back on the idea of, having some sort of limit. I think where the issue has been is, well, where should that limit be? And should boards make that decision, or should the regulator make that decision? That's really where it is. So the kind of core of the problem, I think, is well recognised. But we're looking very, very closely at it, and we know that there is this tension between trying to get good governance and allowing flexibility. And we do know that there are good people on boards who have been there for longer than 10 years. So that's work in progress.
One more audience question from over there. What have you got for us?
Hi, John. Hi, John. Grant here from FIS. We focus on payments and banking industry. My question to you is in regards to the rise and potential legitimisation of stablecoin. Does APRA have a position on that?
I'm loaded up on my Trump dollars myself. I made this clear last night. I've cashed in all my Doge. I've moved it across to Trump's stablecoin, and I am ready to rumble. What are your thoughts on, I presume you're loaded up to the eyeballs yourself, John. What are your thoughts on stablecoins?
Thanks, Adam. It's a really important issue. And I'll start by just saying I've just come back from Bangkok yesterday where I attended the EMEAP, and this is one of the big topics of discussion, stablecoin, tokenisation, how countries are thinking about it, how you should regulate it, really, should you, and in what form? So there's a lot of questions, a lot of sharing of information going. The key regulator that's looking at this is the Reserve Bank. I sit on the payment system board. It's something that we talk about. I think the short answer is we're looking at use cases. There are certainly, you can imagine strong use cases, but there are other risks involved as well. So, there's just a very close look at the issue and sharing of ideas, I think, at this stage. But the Reserve Bank primarily have key responsibility. Where it sort of plays back to APRA is really in the stored value facility area, where the government has indicated that they will introduce legislation and will have a role in that.
Thank you as always, John. Fascinating stuff. Please give John a big round of applause. Thank you so much, John Lonsdale, Chair of APRA.
Thanks, Adam.
After you.